As of the market close on Friday, June 5, 2026, Datavault AI Inc., trading under the Nasdaq ticker symbol DVLT, finished the trading session at an exact price of $0.4668 per share. This represents a minor, flat intraday movement from its open of $0.4670, as the equity struggled to establish any real upward trajectory during active trading hours, despite massive news hitting the wires earlier in the week. While the market seems to be treating this microcap stock like a typical speculative penny stock, something extraordinary is happening underneath the surface that almost nobody is paying attention to. On May 30, 2026, the company signed a non-binding term sheet for a staggering $2 billion structured financing deal with a major institutional investment fund and a UK-based regulated investment platform. Think about the mismatch here. We are looking at a business with a market capitalization sitting under $40 million, whose stock trades at less than 50 cents, suddenly positioning itself to absorb a multi-billion-dollar capital injection. The details of this filing reveal a corporate transformation that is completely disconnected from the current share price. The structured financing is designed to be executed across 4 successive tranches of up to $500 million each, with the first block aimed for completion by the third quarter of 2026. The structure of this deal contemplates issuing common stock at a valuation between $1.55 and $2 per share in exchange for preferred units in a fixed income vehicle. That means institutional entities are negotiating a framework that values these exact shares at 3 to 4 times the current market price. The general consensus among individual investors utilizing common online investing sites or looking for investment help on a standard self-investing app is that microcap companies printing massive headlines are just looking to pump their stock. The common expectation is that a company trading under 50 cents claiming a multi-billion-dollar deal must be a mirage. Retail traders look at the historical performance of what used to be called WISA Technologies, a business focused on wireless audio standards, and assume this is just another desperate pivot to catch the latest artificial intelligence buzzword trend. The reality, however, is a deeply complex, highly legalistic structure that presents an extreme high-risk, high-reward asymmetric setup. The term sheet includes an exclusive global mandate forcing the institutional counterparty to route all its digital asset tokenization and blockchain infrastructure initiatives through Datavault AI's patented platform. This is not a simple equity line of credit, it is an infrastructure marriage that could fundamentally change the corporate identity of the business. To understand the trading dynamics playing out over the last few days, we have to look closely at the daily swings and the massive volume spikes hitting the individual brokerage accounts. When the $2 billion announcement dropped, volume surged as active traders on the Robinhood app and Interactive Brokers platform scrambled to figure out if the news was real. Yet the price has remained pinned down near the 46-cent mark. Why is that? The answer lies in the intense skepticism surrounding the structure of the deal. To secure the very first tranche, Datavault AI faced a binding obligation to pay a non-refundable $25 million upfront administrative fee by June 4, 2026. The company reported that it intended to fund this massive cash outlay through Bitcoin sales and existing receivables. For a company of this size, burning $25 million in cash on a deal that remains non-binding is an immense gamble. If the definitive agreements fall through during due diligence or fail to receive shareholder approval, that cash is gone forever. This is exactly why the stock is not trading at $2 today. The market is pricing in the enormous execution risk and the immediate liquidity strain of that front-loaded fee. Institutional activity in the open market remains light because big asset managers like Fidelity Investments or Charles Schwab tend to avoid microcaps and under $1 in share price. You will not find Datavault AI making up a core holding in popular Fidelity ETFs, Fidelity mutual funds, or the automated algorithms of Schwab Intelligent Portfolios. This leaves the asset completely in the hands of active retail traders utilizing specialized trading platforms. The macro pressures on the microcap sector have also been brutal. High interest rates have starved speculative technology companies of traditional bank debt, forcing companies to seek alternative complex financing vehicles like the one detailed in this recent 8K filing. If you look at the balance sheet from the last reported quarter ending March 2026, the business recorded revenue of $3.42 million against an operating expense of $25.33 million, resulting in an EBIT loss of over $27 million. The current trading volume reflects a massive tug of war between short sellers who believe the cash burn will cause insolvency before the third quarter capital arrives, and aggressive buyers who are treating this as an absolute bottom play. Now, let us step back and look at what this business actually does and how it arrived at this bizarre intersection of high finance and penny stock volatility. The company was originally formed back in 2010 as Summit Semiconductor, eventually becoming WISA Technologies, before changing its name to Datavault AI Inc. in February 2025, following an asset purchase from privately held Datavault Holdings. The business operates across 2 distinct segments that sound like they belong to completely different entities. The Acoustic Sciences division owns patented technologies for spatial, multi-channel wireless high-definition sound transmission, commercialized under the WISA E and ADIO brands. Meanwhile, the newly integrated Data Science division focuses on Web 3.0 data management platforms, utilizing artificial intelligence agents called DataScore and DataValue to help organizations securely value and monetize their enterprise data assets. They are attempting to create an ecosystem where physical, real-world objects can be securely attached to immutable metadata, creating digital twins that allow corporations to license assets like name, image, and license with absolute security. The core revenue engine has historically been lumpy, driven by licensing wireless audio modules to consumer electronics brands, but the future of the company is now completely tethered to the emerging sector of real-world asset tokenization. This process involves taking a tangible asset like real estate, energy infrastructure, or fixed income portfolios and creating a digital representation on a blockchain network.
By integrating IBM's Watson X platform, Datavault AI claims it can offer data valuation and corporate financial modeling without risking regulatory scrutiny or privacy violations. It is a highly ambitious business model that attempts to merge advanced artificial intelligence analytics with distributed ledger technology. The past financial reports show a legacy business that was consistently losing capital on its hardware lines, which explains the aggressive corporate restructuring and the complete rebranding over the past year. Please take a moment right now to leave a comment below with your specific strategy on this asset. Comment below how many shares of Datavault AI stock you currently hold in your personal portfolio, or if you are choosing to stay completely on the sidelines due to the dilution risks. It is incredibly valuable to see how real traders are navigating these microcap setups, so drop your thoughts down in the comment section. Looking ahead, the future outlook for Datavault AI depends on two distinct scenarios that will unfold over the next few months. The bullish case rests entirely on the successful closing of the first $500 million tranche by the end of the third quarter of 2026. If the independent valuation confirms the asset base, and the company secures definitive agreements, the injection of capital will completely erase any bankruptcy fears. Furthermore, because the deal contemplates issuing stock at a minimum of $1.55, any progress toward that closing will force an aggressive upward re-rating of the equity, triggering a massive short squeeze on the trading platform. The strategic exclusivity could turn Datavault AI into the primary technological backbone for a multi-billion-dollar digital asset exchange network, driving immediate software-as-a-service licensing fees straight to the bottom line. Conversely, the bearish reality is centered on extreme structural dilution and corporate control shifts. The filing explicitly notes that the institutional counterparty will gain significant board nomination rights with each tranche. Upon the final closing, the counterparty would possess enough voting power to elect a majority of the directors, meaning the current management team is effectively selling control of the entire company. More importantly, to fulfill this deal, Datavault AI must pass a charter amendment to vastly increase its authorized shares. This means the total outstanding share count will explode, heavily diluting anyone buying the equity today. If the deal falls through after the $25 million fee has been paid, the business will face a devastating liquidity crisis with almost no traditional path to survival. To sum up the core insights, the expectation among casual market observers is that Datavault AI is an unstable penny stock printing unachievable headlines to stay alive. The reality revealed in the financial filings is a highly sophisticated, multi-stage $2 billion institutional term sheet that could completely transform the business model, but comes at the cost of massive share dilution and the total loss of corporate control. The contrast between the stock price trading at $0.4668 and the negotiated transaction price of over $1.55 shows a massive disconnect that will be resolved the moment the third quarter deadline arrives. It is a stark reminder of the massive gap between public market narrative and institutional structural finance.